Hello, and welcome to another edition of Equital Conversations. My name is Gerald Ashley, and as ever, I'm joined by my good friend and colleague, George Cooper. George, welcome to the first podcast of the new year.
Thank you, Gerald. Looking forward to it.
Now, New Year is always a sort of strange time, although we're bashing through January as I speak, in that people feel everything has to be reset and reevaluated. And, we start afresh and look at everything afresh. I'm going to suggest that what's going on in financial markets at the moment is a continuation of a trend that really started to unfold last year, which is this whole business of the debasement trade that was promulgated, I think, originally by JP Morgan. In brief terms, that fiat money is in a bad shape, and that we're seeing tremendous moves in prices in bullion, both in gold and the speculators' favourite, silver. Now, you and I, with a good friend of ours, Doug McWilliams, went to dinner a couple of weeks ago at the Savoy Grill. I can assure listeners it was a deeply serious research project and is linked to the price of gold. So maybe a good way to look at this whole business of what's going on with the debasement of assets in fiat money is to start with what I think we would now call the Savoy Gold Dinner ratio. Perhaps you can explain.
Yes, well, I mean, you get the credit for sparking this whole adventure off, Gerald. So basically, just for the listeners, I'll explain what happened. So Gerald and I were in a meeting a few months back, and the conversation turned, as it frequently does, to the price of gold. And it was then that Gerald recounted this story that I'd never heard of, but it was a story of a former star fund manager, a gentleman called Julian Baring, who I think it was the 70s, 80s and 90s, he used to manage funds of gold mining stocks. And every now and again, he would present a quirky way of looking at how the price of gold was changing in terms of its purchasing power. And the way he did it was through what he called his Savoy Gold ratio, or his Savoy Dinners ratio. So he would go for dinner at the Savoy, have a slap-up meal, record the price of it, and then in his research notes, tell his readers how much the dinner had cost in terms of the prevailing price of a gold sovereign.
Hard work then, obviously.
It was clearly he was suffering for his craft. So when Gerald recounted this story, I thought immediately, okay, it's time for Gerald and I to take up the mantle and to make this open-ended commitment to fine dining. So we decided that we would resurrect Julian Baring's Savoy Gold ratio and go to the Savoy, have dinner, and report back on what that cost in terms of gold.
And it turns out to be quite a fascinating tale, really, doesn't it?
Well, it is. So, and I'll give you the figures in a moment. But so we did that on January 7th. But obviously we wanted to be able to get some sort of benchmark to compare where the prices are now against where they were historically. Unfortunately, we managed to find a complete copy of the Savoy Grill menu from August 19th, 1971, with all of the prices there.
A very critical period, of course.
Yeah, very, very critical. That was a great menu to find because that was just 4 days after President Nixon's Nixon shock, which is when he took the world off the gold standard. So what we could do with that menu was work out the equivalent cost of dinner at the Savoy just as the world was coming off the gold standard.
Right.
And compare that with today's costs and see how those prices and purchasing powers have changed over the last 54 years, which is what I would call the fiat monetary regime.
So we came up with a fixing, and what was the result of the the 7th of January dinner?
So the fixing, the first dinner, I can tell you. So Julian Baring picked the Savoy Grill because it was eye-wateringly expensive and considered to be a sort of very premium place to have dinner. And I can tell you that today it is still eye-wateringly expensive. So the dinner came to £236.32 a head.
A head?
A head, yes. That is including the tip. And that is, I should say, that is choosing from pretty close to the bottom of a ferociously expensive wine list. So we were very conservative. Now, some interesting stats about that. So that £236 price, that compares to the price of gold, which on the day was trading at $4,460, which works out at £3,303 per ounce. So we look at the ratio of those two costs, and that gives us, on January the 7th this year, a gold ratio of 14 dinners per ounce. So 1 ounce of gold will buy you 14 dinners at the Savoy Grill today.
So if you're the lucky owner of an ounce of gold, that sounds like a really good deal. I mean, that's taking all, close friends and family out, all on an ounce of gold.
Well, I have to say it was more than I thought. But then it gets really interesting when we work out what the cost of dinner was back in 1971. And from the menu, we went through it carefully and we picked as similar items as we could from the menu. And that came to £5.67 a head.
Good Lord, that was when a pound was a pound.
Yes, that was when a pound was a pound. £5.67 a head. Now, back then, as I said, we'd just come off the gold standard. So gold was trading at about $40 an ounce then, because it leapt up immediately after Nixon came off the standard. And back then, the sterling dollar, the cable rate, was pegged at 2.4. So the pound was worth much more. So that gives us a value of £16.66 per ounce of gold.
Right.
And when we work that out, that means that in 1971, an ounce of gold only bought you 3 dinners at the Savoy.
Now, that is a hell of a range. And it sort of prompts a couple of comments straight away that if I do live in a world where I use sterling all day long, the Savoy is frighteningly expensive and was pretty expensive in 1971. But if I lived in a sort of parallel universe or was sufficiently wealthy enough to have gold sovereigns to hand, it's unbelievably cheap. So there's almost an inflation and a deflation element to this story.
Yeah, in terms of gold, that particular cost has got cheaper. But we can go a bit further because the ONS, the Office of National Statistics, helpfully publish average weekly salaries in 1971 and average weekly salaries today.
Right.
So if I just find those figures, so basically the ONS says that in 1971 the average weekly wage in England was £20.
£1,000 a year, basically, around £1,000 a year.
There or thereabouts, yes. So weekly £20, and today it's £736. Now, that means that in 1971, dinner at the Savoy Grill cost 1.4 days of wages.
And that's maybe a better way to think about the true cost for somebody, I suppose, really.
Yeah, so 1.4 days of wages. But interestingly, today, it's almost the same cost. Today, it costs 1.6 days of wages.
Right. That is interesting.
So actually, we can say from that it's the Savoy Grill has retained its sort of eye-watering status as an eatery over that 54 years. It's retained its price relative to wages
without probably having known that calculation, but they've obviously managed to keep it in step. That's quite interesting.
My guess is actually it sort of happens naturally, as in I suspect the bulk of the cost of eating at the Savoy Grill is actually labor cost. It's the chefs, the cooks, the staff in the hotel and the restaurant. So naturally, the price will keep pace with wages. So that's kind of interesting. But in terms of purchasing power, then what does it mean? Well, it means that gold has increased its purchasing power relative to 1971 by about 4.7 times. So gold hasn't just been a good protection against inflation. It's actually, even though it doesn't produce any income, it's actually produced a real increase in purchasing power. So it has actually been a fantastic investment in that period.
It has to be a buy and hold, of course, because one could have been rather unlucky and bought in the 1980 spike of around $800 to $900 an ounce. So it is a very long term, and it depends. There's path dependency here as well, obviously, as to what level you get in at.
Yeah, this is only two fixings at the beginning and now the end of the regime. If any of our listeners happens to have a Savoy Grill menu from 1981, I'd be really fascinated.
I'm sure we'll be flooded by our very wealthy listeners demanding to show it to us.
So there's that side. But unfortunately, what we can't do with this set of data is, while we can say that gold has gone up in value, it has been a good investment, a good store of value. What we can't say is it expensive now?
No.
We know it's more expensive than it was in 1971, but we also know that in 1971, gold was fundamentally extremely cheap. And we know that because that's why Nixon was forced to come off the gold standard.
Indeed.
Because his dollars were artificially overvalued relative to gold.
Yeah.
So we can say with a pretty high degree of certainty that 3-to-1 ratio in 1971, when an ounce would buy three dinners, we know that was probably the wrong price. It should have been able to buy many more dinners, and a few years later, I'm sure it did. But what we can't say is whether today's price is wrong. But
more research. I think more research will be needed.
Yes, we plan to repeat the exercise next year and see what's happened. Anyway, we thought that would be interesting. We're going to write this up and we'll send it out to our readers and put it on our website. And for those that have a login to the Times newspaper, the Times have actually written quite an extensive article about our escapade at the Savoy Grill. So feel free to look that up and read about it.
Excellent. Now, of course, this podcast today we've called Let's Get Physical, and no music will be coming from Olivia Newton-John, but the point was the wider one, which in a way we've already started to address with the bullion price, which is that physical assets are starting to look attractive and, well, not just attractive, maybe important. The great surge and, dare one say at the moment, excitement about digital assets may be somewhat curtailed as the real physical world gets in the way. And the example I would think of straight away is obviously AI and all the huge amount of hullabaloo around that sector. But it could well be constrained by the cost and time of putting in data centers and, believe it or not, simple things like the price of copper. So are we going back to, maybe paradoxically, a more physical asset world rather than just, dare one say, the ephemeral world of software and AI?
Yeah, I think this is an interesting question, Gerald, because there's a few trends going on in financial markets at the moment that are pointing in a similar direction. So we've got the one we've sort of implicitly been talking about already, which is that gold is increasing in value and arguably becoming the investor's favorite sort of risk-off trade or safe haven trade. And it's displacing the previous safe haven asset, which of course was US Treasuries and government bonds generally.
Yeah.
So we've got a process there where the physical asset of gold is becoming more attractive, and the the fiat money system where you can just reproduce money without really any constraint forever, that's going out of favor. And I see a similar thing happening in the stock market where we've got mining companies, for example, commodity companies generally, becoming more attractive for investors. They're going up in price, up in valuation. And there's another cluster of companies on the other side that are suffering quite rapid deratings. And that group is broadly called software as a service companies. And the fear, I think, in the market is that AI can sort of quite easily reproduce the services that these software companies are delivering. I mean, the obvious case that a lot of people are talking about is if you want to generate a digital image for an advertising campaign, in the past, you might have used the Adobe software suite and had some very, very skilled digital artist create the image that you want, pay them a lot of money to do that, pay Adobe a lot of money for their licenses to do that. Whereas now you go to an AI image generator and you give it a few commands, you tell it broadly the image you want, and you go through a sort of iterative process until you get one you like, and it costs essentially nothing to do that.
Now, that is a powerful force in commerce and business of commoditization, isn't it? And thinking back over the years, I've always been told that as a product, you don't want to be a commodity, that markets punish commodities and that profit margins get very tight, if not disappear. And so, as you're saying, there's maybe a whole cohort rather of companies such as Adobe, that's just one example, that could be under really serious threat.
Yeah, I mean, what I think we might be witnessing is the realization that it is very difficult to keep a moat around a digital asset, because by definition, the reason digital technology emerged was because you can create perfect reproductions of digital files very easily and very cheaply. So it's very copyable. And this potentially ripples through into all sorts of companies. So, for example, a company like NVIDIA, it doesn't actually make its own products. It designs its own products. Its value is its digital content.
Right.
But if, a few more generations later, if you can type into your AI, a simple instruction, build me a better, or design me a better GPU than NVIDIA's, and ship the files off to TSMC and have them build it for me, maybe there's not much value in that proprietary knowledge anymore if it can be replicated.
Now, that's a delicious irony, because in a sense, it will be eating itself. So definitely one to watch. Most interesting.
Yes, it is actually. It is quite a fascinating thought. So maybe we're seeing, there's a realization of this happening in the investment world, and there's a realization of it happening in the monetary world with fiat money versus traditional gold money, and the two, of course, are intimately linked. So
now, as we widen this out a bit, this is going to lead to other physical assets, things such as, I just mentioned the copper price. Maybe we're going to see it in terms of shipping as well, in terms of just moving physical goods around the place. Are there any other sectors that you could see that would come out of the doldrums and be quite a big sea change in what's going on?
Well, looking at the way the markets are trading at the moment, it seems to us that the process is spreading now beyond the precious metals. It is going into the industrial metals. There's some signs that it's already starting to go into other chemicals, things like fertilizers and other chemicals. It certainly hasn't happened yet in oil, which is a traditional inflation metric, but perhaps it will go there as well. So, yeah, I think it is broadening out, and maybe we're going to see a change of investor sentiment where a few years back, we were all in love with asset light companies.
Yeah.
We like profit heavy asset light. Now, a lot of those profit heavy asset light companies, which were basically the software companies, they're now reversing that and becoming asset heavy profit light as they are forced to invest more and more in data centers. So maybe our love affair will move away from those companies and return back to, things like shipping companies where they've got a tangible asset.
Yeah.
Maybe mines where they've got a tangible asset, factories where, we can see some tangible thing that can't be just reproduced digitally.
Now, one of the sort of, I was going to say unintended consequences, but I mean, it's in a way it just naturally flows, is that you could say that we're going from a world that initially didn't need a great deal of capital to one that needs a huge amount of capital. Certainly the physical world has always been very hungry for capital, and the people who are investing in data centers, not to mention talk of modular nuclear power plants, believe it or not, are going to need to have very deep pockets. And I wonder, does that slightly tilt the world in terms of government's ability to service its debt? Because there's going to be more demand now for capital and for borrowings.
I think that's a very good point, Gerald. I'm not sure if I've said this on the podcast before, but I've certainly written about it before. It looks to me like most of the governments in the world are now in what the economist Hyman Minsky called the Ponzi stage of finance. And for readers that don't know what that means, Hyman Minsky was an economist that studied monetary cycles and particularly credit cycles. And he used to talk about three phases of finance, which he called the hedge stage, which was where you bought assets with money you actually had.
Yeah.
And then he called it, I think the second one was the speculative stage, where you would buy assets on the belief that the income from those assets would service the cost of the borrowing that you'd made. So the asset would have a higher yield than the debt that you'd borrowed. And then finally, he talked about the Ponzi stage of finance, where the interest charge on your debt was way above any earnings that you were getting from your assets, so that you were obliged to continue to borrow even more money just to service the debt for your previous assets. And once you get into the Ponzi stage of finance, of course, your debt just mechanically rolls up and gets bigger and bigger and bigger. And I think that's pretty much where we are with government finances now.
We've got my favourite word, which has come into the lexicon a lot in the last year, which is trillion. Nobody talked about trillion until quite recently. Now, UK government debt is well over $1 trillion. And even more sort of shattering number is that the interest on the US debt is over $1 trillion a year. And that's got a bit of a Ponzi feel to it, hasn't it?
Yeah. I mean, I think the reality of the answer to your question about, where's the capital coming from to fund all of these data centers, for example, basically we're printing it.
Yeah.
And where is it coming from to fund the deficits? We're printing it. And this is essentially why we're starting to see physical assets command a premium, because people are worried that we're printing too much of it.
Now, maybe one last little point before we come to the end of this first podcast of the year. Rather paradoxically, as gold and indeed silver and platinum and all the rest of it has been going skywards, Bitcoin has stalled and is sort of clinging on about 25% below its all-time high. That seems strange.
Yeah, that's an interesting one, because, of course, a lot of people that were talking about the debasement trade 18, 24 months ago, a lot of that cohort were positioning for the debasement trade with Bitcoin. And it turns out that that's not been the asset that's benefited from it. And, maybe again, this is the same the same process, investors are beginning to realize that Bitcoin is a digital asset and it can be reproduced without limit. Now, we can't, of course, people will be writing in and shouting at me for saying that, because the Bitcoiners do like to emphasize that there's only a certain number of Bitcoin that can be made from.
But there's plenty of substitutes out there, right?
Yeah, there's nothing to stop. There's nothing to stop us doing Bitcoin tranche 2, tranche 3, tranche 4. We're already basically doing that. There's lots of different cryptocurrencies out there now. So yes, digital currency can be reproduced. It's only really a social construct that tells us that this particular version of digital currency is special.
That's a nice grenade to throw into the pond of looking forward, if mixing metaphors, but looking forward this year. But it is at the very least, as I say, paradoxical that that's going on. Well, there's loads to chew on there. Dinner at the Savoy, the return of metal bashing and physical assets, and maybe some doubt about the defensive quality of digital assets, the famous moat that Warren Buffett always looks at when making investments. Can you defend your profit margins? So lots of these themes I think we'll come back to in future episodes, but let's call it a day on that side of things, and we'll do our usual trick of recommending a couple of books at the end of the podcast. I've gone for a book. It is older than I realized. It's been on my bookshelf, I guess, when I first bought it in 1989. It's by the sort of popular scientist, quite a serious scientist, but he's written some very good popular books for people like me. And it's called Does God Play Dice? The Mathematics of Chaos. And it's a very easy, straightforward primer on all the issues that are now much more talked about chaos theory, strange attractors, how the patterns seem to emerge and then, if you like, submerge. And it's a very good read. Ian Stewart, and I think George pointed out to me that Does God Play Dice is a quote, or a partial quote, from Einstein in his conversations with the Danish physicist Niels Bohr. One last point, which I always look for in this book: there is very, very little in the way of frightening mathematics. So, the old adage that if you put in a formula, you halve your number of readers. I don't think people are going to find this a strenuous read. So, Does God Play Dice by Ian Stewart.
Okay, Jonathan, I'm going to go for a history book. I'm a bit of a sucker for history, especially ancient history, funnily enough. And I'm going to go for the book Genghis Khan and the Making of the Modern World by Jack Weatherford.
Right.
I've read this book a couple of times, and I found it even more interesting the second time round. There's a few things that really jumped out at me with the history of Genghis Khan and the Mongol Empire. And one is that it's not the sort of simple, brutal, bloodthirsty empire that we learn about in history. It was actually a surprisingly multicultural empire. There's documentary evidence of the Mughal court holding debates between Muslim, Christian, and Hindu philosophers to try to find out which had got the better belief system. And indeed, the army was multi-faith and multicultural. And Genghis Khan himself pioneered the process of hiring people based on merit and not on family connections. So, all fascinating stuff. And there's also an interesting monetary angle to the Mongol Empire. They were one of the first, maybe the first, to start issuing a version of the paper money system. And they did that to try and make it safer for traders who were moving goods across the steppes.
Right.
They could carry paper rather than gold. And of course, as soon as they did that, they immediately ran into a problem of people were issuing too much paper. So they had to start a prototype central bank to control the issuance of the paper. So that's an interesting sort of little side story to all of this. And then finally, towards the end of the book, it talks about how Genghis Khan and the Mongol Empire got its bad reputation. And it turns out that's actually quite a recent thing. It comes from a period in French history when it was illegal to criticize the French king. So French playwrights started writing plays which were critical of Genghis Khan, using Genghis Khan as a metaphor for the French king. And that sort of did for his reputation.
Well, we've tied quite a few bits of string back together there at the end with the emergence of central banking, paper money, and we've managed to have a slight dig at the French again, which we should try to temper our views on that maybe, but quite an interesting little sidelight on Genghis Khan. George, thank you very much for today. More of these themes as the year unfolds, I would think. But for now, thank you very much.
Thank you, Gerald.